Hey everyone, welcome back to Corporate Decoder. Today we're diving into the latest report from Forum Energy Technologies. Get ready, because this one has a few surprises, or maybe not if you've been following the energy market closely. We are going to analyze their financial moves and see if their energy is well spent. This is an 8K report, which is basically a company's way of saying, hey, something important happened and we need to tell you about it right away. In this case, it's about their earnings for the first 3 months of 2025, which ended in March. They released a press statement and we're going to check that press statement to find out what it is all about. The main focus here is on Forum Energy Technologies' financial results, so we're going to dig into those numbers and see what they really mean. This includes the good and not so good. It's like when you go to the doctor, they tell you everything, not just the things you want to hear. Now, here's a quick explanation of some financial terms you will encounter in the report. You will see something called non-GAAP financial measures, AP, or generally accepted accounting principles are the standard rules for how companies in the United States have to report their financial information. Non-GAAP measures are like looking at the financial results with a slightly different lens, focusing on what the company thinks is most important. In this report, they highlight earnings before interest, taxes, depreciation, and amortization, or EBITDA. It's a way of seeing how well the business is performing before these financial costs are taken into account. We also have terms like adjusted diluted EPS, which is adjusted net income per diluted share. This measures how much money the company made per share, but after some adjustments to give a clearer picture. You'll also see free cash flow, which is the cash the company has available after covering its operating expenses and capital expenditures, or spending on things that will last for a long time. It tells us how much money the company has to spend on things like new projects or paying off debt. Let's get to the important part, the actual numbers from the first quarter of 2025. We need to jump to Exhibit 99.1, the press release itself, to get the full details. Think of it as going straight to the source for the real story. Okay, now we're looking at the numbers. Total sales or revenue for the first quarter was $236 million. That sounds like a lot, and it is. But here is the interesting thing, it's down 5.1% compared to the same time last year. Imagine you were selling lemonade. If you sold 100 cups of lemonade last summer, but only 95 cups this summer, you would be in a similar situation. Fewer sales can mean less money to invest in the company. The cost of sales, which is how much it cost them to make their products, was $183.5 million. That means after subtracting what they sold from how much it costs, you get a gross profit of $50.7 million. They're making less money even before paying for other things like salaries or rent. Operating income, which is the money they make from their normal business operations after taking into account all their expenses, including administration, was $10.8 million. A year ago, it was $18.4 million. Imagine you run a store, this is your profit after you pay for the products, the employees, and the lights. But before you pay things like interest on loans, a decrease shows that the company is earning less from operations than it did previously. Net income, what's left after all the expenses and taxes are paid, was $3.2 million. That's down a lot from the $12.7 million they made last year. So after doing all that work and paying all those bills, the company made significantly less profit than the year before. It is like working an extra shift but getting paid less. Adjusted EBITDA, which we talked about earlier, was $28.3 million. Again, lower than last year's $33.5 million. Although it's still a good number, the trend is not good. It's like having a high score in a video game, but it's not as high as your previous high score. Now let's peek at how much cash they have. As of the end of March, they had $60.5 million in cash. It's good to have cash, just in case you need it. Looking at cash flow, the money they are actually bringing in, they had $20.8 million from operating activities. They generated more cash this year than last year. This is like checking your bank account, which went up because more money came in than went out. Then they spent $2.8 million on investing activities, like buying new equipment. Imagine you are a farmer. This is like buying a new tractor. It costs money up front, but it can help you make more money later. They spent $7.4 million in financing activities, which includes things like paying back debt. It's like paying off your credit card, which reduces your debt, but also lowers your cash. The company says they believe they have enough liquidity, meaning they have enough cash and ways to get cash, to meet their needs for at least the next year. It's like saying you have enough gas in your car to get to where you need to go. They ended the quarter with $380.6 million in orders they have not fulfilled yet. That is called backlog. Their book-to-bill ratio, which measures the orders they received compared to what they billed, was 0.96. This is not great. Ideally, you want this to be above 1, meaning you are getting more orders than you are filling. Below 1 means you are filling orders faster than getting them. Looking forward, the company expects their sales to be between $245 million and $255 million in the next quarter. They also expect their EBITDA to be between $33 million and $37 million. So they are hoping for a bit of an improvement. Here's what I think. While Forum Energy Technologies is navigating a tough market, it shows some resilience. The decrease in revenue and net income is a clear warning sign, indicating the company is facing challenges, but their cash flow from operations looks pretty good. The company's strategy seems to be focused on maintaining liquidity and managing costs carefully. The lower book-to-bill ratio is something to watch, as it indicates that new orders aren't keeping up with the pace of completed work, so they might need to put more effort into sales. Risks? Well, the energy sector is always changing, and they mention weakness in some product lines. So they need to stay flexible and adapt to the market. They seem to be doing fine, but they need to be agile to compete. Overall, I would say the company is in a position to maintain its ground, but it needs to be careful of the market changes. Thanks for watching. If you found this breakdown helpful, don't forget to like, comment, and subscribe for more deep dives into the world of corporate reports.